I'm Razan Hilal, Market Analyst with Forex.com. Today is May 5th, 2026. I'm going to run this 1-minute disclaimer in the background before we dive into the charts. Just to clarify that this webinar is for educational purposes only and not for trading advice. There are there's a confluence of factors that are affecting the charts these 2 weeks, of course, with main U.S. economic reports between the U.S. NFPs this Friday, and of course the inflation reports next week, as the Strait of Hormuz is still in escalation mode as we enter the week 9 of this conflict, and we're playing out certain factors that may catch up to the charts, even those that are reflecting a bullish momentum at the moment. So we're starting with the Bitcoin chart, followed by the US dollar index. Then we're going to go over the crude oil charts, precious metals, and the US indices. The 1-minute disclaimer is up, and we'll be starting with the Bitcoin chart. So in the beginning of this series, we've been talking about the Bitcoin chart holding at a confluence of bullish factors between the oversold RSI last seen in 2022 and alongside the alignment of the price action with the golden 618 of the overall uptrend between 2022 and 2025, and the alignment also with that rebound with the highs of 2021, which gave way to that bullish rebound on the Bitcoin chart towards the 80,000 mark, and also towards the 50 neutral threshold on the weekly RSI indicator, and also towards the upper bound of a parallel channel that the price action has been respecting following that bullish rebound. So over here, we're back at the critical level, which is near the 80,000 mark, and also aligns with the lows of November 2025, which is also the bottom bound of that bearish wedge that extended its target down towards the 60,000 zone. So over here, we're going to need to have a sustained close above the 80,000 to the 83,000 zone to be able to extend further bullish forecasts on the Bitcoin chart towards the 90,000 mark and towards the highs of January 2026. So that would be the 97,000 zone for a final test for either another pullback risk or a bullish breakout back towards the record highs on the Bitcoin chart. And of course, that scenario would likely be accompanied with a stronger investor appetite, stronger risk appetite across the markets, and also preferably a wind down of the tensions that we're currently seeing between the Middle East conflict and a possible Bank of Japan intervention in the markets that can unwind carry trade and cap risk appetite further. Now, from the downside, should you have a clean close back below the mid zone of this short-term uptrending challenge that is below the 73,000 to the 71,000 zone, we can possibly retest the bottom bound for another bullish rebound near the 68 to 67,000 zone. If not, a clear hold below that is likely to extend losses all the way down towards the 60,000 zone for either another bullish rebound or another extended leg lower towards the 58,000 to the 48,000 zone, lining with the lows of August 2024 that are likely to open up possibly another dip buying or long-term bullish positioning for investors on the Bitcoin chart. So that is for the Bitcoin. Next, we have the US dollar index, which is still holding its consolidation and its 2008-2026 uptrending support reflected here on the monthly time frame. So if we manage to have a potential Bank of Japan intervention, we can possibly have a pressure on the US dollar index, but that would also require a clean close below the 95 mark to confirm further bearish drawdowns on the DXY, which can possibly extend a steep drawdown towards 2021 lows near the 89 mark. And this scenario would likely drive a strong uptrends across major currency markets. From the upside, should the DXY sustain that bullish hold and further close back above the 99.50 and the 100.60 zone, a critical resistance and support for price action. Since March 2023, we can extend bullish forecasts on the DXY towards the 104.40 mark, which is likely to further pressure global currency pairs and precious metals, gold and silver. So these are key levels we have in sight for potential structural shifts on the DXY chart, and with the confluence of these factors and potential hawkish tilts for central banks as we navigate the implications of one of the largest energy shocks in history, which is rippling onto inflation reports worldwide. Next, we have the crude oil, which is still holding near the $100 mark as we enter the week 9 of the Middle East conflict. Now, if we look at the crude oil chart from a 2-week time frame, we can see a clear resistance here between the $100 to the $103 per barrel, and the key close above this level is likely to extend another bullish rally towards, or short-term bullish rally towards the 109 to the 115 zone, and this level is likely to either create another pullback risk or open the way for a bullish breakout to new highs on the charts above the highs that were last seen in 2022 during the Russia-Ukraine invasion, as this is not just risk premium trade, but also structuring for or the pricing of structural challenges for the energy market. And so a clean close above the 115 zone is likely to extend bullish forecasts towards the 136 to the 160 zone. And these levels are derived using Fibonacci extension tool placed between the lows minus the extended volatility of 2020, the highs of 2022, also minus that extended volatility. So we're replacing the Fibonacci extension tool near the closes of that price cycle between 2020 and 2026, where we can see that the latest rejection in the price action is going to align. So where we can see that the latest rejection here with the price action aligns with the golden 618 near the 118 mark. And the clean close above this level is likely to extend bullish forecast toward the 78.6 near the 135 to the 136 zone. And the clean hold further would likely extend it to the 100% Fibonacci extension ratio near the 157 mark, or to round it up towards the $160 per barrel. Now, for the downside, should we have a clean hold back? So over here, we had the preset scenarios between the long-term bullish and neutral and bearish scenarios on the crude oil chart that are still respected and holding, as we saw that the latest drop towards the $76 zone, also supported by easing tensions and potential open for the Strait of Hormuz, recorded a very strong rejection for the zone, and that's because this level not only aligns with critical Fibonacci retracement ratio, but also aligns with the highs of last year's Middle East conflict, also involving the US, Iran, and Israel. So it's a confluence of an event and a critical price level on the charts. We're going to need to have a clean breakdown below this level to be able to extend the long-term bearish consolidation on the crude oil charts once again. Short-term support levels before reaching that mark once again would be below the 2023 highs, which are the defining barrier between long-term bullish positioning and neutral to bullish positioning, and that would be below the $88 to the $84 zone for potential short-term rebounds. If not, we can revisit that area for either another rebound, or if we do manage to have that clear breakdown below that level, signaling the unwind of the geopolitical risk premium and they resuming the normal flows of supply of crude oil supply across the markets, crude oil can possibly revisit that critical level, which acted as a previous resistance and support for price action, at least since 2019 on the charts. That is near the $67 per barrel. For now, we're still holding that bullish bias unless we see a clean breakdown below the mentioned supports. That is for the crude oil chart. Okay, now for the gold chart, we're going to drop it down to the daily time frame just to visualize a pattern that is mirroring the setup that we saw in March 2026. So we had that steep rebound or rejection for the lows in February 2026, followed by a trend line connecting consecutive higher lows. And then we had the breakdown for the price action below this trend line, extending another steep downfall on the charts. Over here, between the lows of March 2026 and onto April 2026, we also had that same pattern trace out on the charts, where we had also price action breaking below that trend line, connecting consecutive higher lows, and also prices tracing not a downtrend, not as smooth as the one that we saw in March 2026, as markets tend to rhyme and not exactly repeat. And we're holding currently at the 4,500 support, where we can define using Fibonacci extension tool, placed between the highs of March 2026 and the lows of March 2026, followed by that peak over here of the April 2026, where we can see that prices are currently holding near the 27.2% Fibonacci extension, near the 4,500 zone. And if he goes below 4,500 or 4,480, taking into account the volatility on the chart, likely to extend drawdown risks towards the 3 to near the 4,380 and further towards 4,230 and 4,080, which aligns with the lows of March 2026, before extending the drawdown risks towards the 3,800 mark on the charts, respectively, and possibly 3,500, which was a level that acted as a resistance for more than 5 months across 2025. And last but not least, we have the Dow Jones chart, which is a chart that gave the signal for potential drawdowns across US indices this year, as the price action reached the top of a consolidation that has been forming since following the bullish rebound from the lows of 2020, connecting consecutive higher highs and higher lows in a contracting manner between 2021 and 2026, where we had that sharp pullback earlier this year from the 50,500 zone. Price action did not manage to close beyond the bounds of this consolidation, reinforcing its strength on the markets. And the latest rebound that we saw on the Dow Jones chart was also aligned with the bottom bound of this consolidation and with the highs of last year's, or with the highs extending between 2024 and 2025. So a clean hold above this level is needed to be able to confirm further bullish positioning on the charts. That would be above the 50,500, which can possibly extend bullish forecasts towards the 51,700 and the 53,300, also derived using Fibonacci extension ratios between April 2025, February 2026, and March 2026. From the downside, I'm going to go down to the daily time frame as well, where we can see a potential new support zone over here near the 48,400. A clean hold above this level is likely to extend bearish forecast towards 47,800 and 47,300, an area where we can possibly have a high rebound probability, as we had a strong rejection from the zone earlier in mid April. If not, we can revisit the bottom bound of that consolidation near the 46,200 for potential rebound opportunity. If not, we can be looking at steeper drawdown risks for the Dow Jones short, possibly also mirrored onto the US indices. So I'm happy to take also any questions following that. Also, wanting the disclaimer, thank you so much for watching. You can find the recording of this webinar on our YouTube and on our LinkedIn handles. And of course, we'll meet in the next webinar. Thank you.